T-Mobile, and a lot of credit should be given to them because over the last 10 years, they've grown the fastest. They overtook both AT&T and T and Verizon from a market cap position. The business has done well for investors. The stock is up more than 121% over the 5 year. Year to date, this stock is doing all right, 14.5. That's beating the S&P. And over the 1 year, it's doing 27% appreciation. The dividend rate is a little low compared to others that I'm going to show you, 1.39%. And it's probably because the stock has risen so much. The PE ratio is probably one of the highest ones we're going to see. Now, T-Mobile does have good profitability, and one thing they have done is they've expanded profits. You can see how they've expanded earnings per share, and that really pleased investors. I think that's why the stock continued to work, even though they had very slow top-line growth. The free cash flow also expanded quite handsomely, $16.5 billion of free cash. That looks really good. Overall, the gross margins for them went up 63.68. I think what T-Mobile is successfully doing is having a product mix that gives them better margins, better profits, better cash flows. Looking at the balance sheet, which is really important for a business like this, T-Mobile does carry a fair amount of debt, $118 billion. That's a lot of debt. And I'm going to use that when I value the company. Debt to EBITDA for T-Mobile is 3.2, right above the limit that I like to have of 3. That's not a complete showstopper. It's right at 3. But as I mentioned in the introduction, these companies tend to carry debt, which makes them riskier and also makes them less profitable because they have to pay a lot of interest. I mentioned that analysts thought they were fairly priced. 22 of them covered the stock. And in general, looking at the forecast that they have for the company, they're expecting it to grow single digits going forward. As expected, this is Telecom. They're so big, it's hard for them to grow. They have terrific free cash flows. And when I discount those cash flows to today's value, I get $351 billion of value, which is attractive. Now, I add cash, but I also take away debt because that debt, somebody has to pay for it. And the equity value comes down to $243 billion, which is below their current market cap. I believe that based on cash flows, T-Mobile is priced 15% too high. The earnings per share is really good, and giving them a PE of 18, I'm going to give T-Mobile the highest PE of the companies that I'm going to look at. And a decent growth rate is 15%. It shows that the stock could be considered discounted if you just use earnings per share by 8%. I combine the two and I put more weight in the free cash flow method. So I actually calculate that T-Mobile is priced 7% too high.